So David, the floor is yours.
Rona, thanks for the nice introduction. My wife is here with me. Her parents are French-Canadian from Montreal. She grew up in New Hampshire. We brought our skates, and we are definitely skating on the canal tomorrow afternoon or Saturday morning, whatever the weather is. But I wouldn't give her a copy of that book for Valentine's Day. and I won't recommend it to you either. It's really a pleasure to be here and participate in this conference, and it's nice to see you all here. So I'm going to try and take about 30 to 35 minutes to talk about this very broad topic of structure of domestic support and implications for trade on a global basis. You know, we're having quite a farm bill debate in the United States, and we could easily spend the next hour and a half talking about just the U.S. Farm Bill, but that's not our charge, although we certainly will talk about the U.S. Farm Bill in this global context. So that's the plan. We're starting about 10 minutes late, and I'll try and wrap up in about 30 minutes. So, let me let's see. Let me start with a few broad questions that come up in my mind about thinking about support for agriculture in an environment of high prices. And many analysts my age, when prices went up in 2008, we'd seen some price booms before in the 70s and the mid-90s and so on. So some of us were skeptical as to whether a period of relatively higher prices was going to persist. And actually in 2009, it started to look like prices were coming down, but various events have occurred. And actually now, at least in the medium term, those who argued that a period of higher, at least some period of higher prices would replace the long secular decline and concerns over low prices that had dominated foreign policy since the 1950s, they've won the short-term debate. I mean, because we've now had 5 years of really high prices, and it looks like they'll persist for some time into the future at least. Whether that's a long-term new secular trend and how much variability year to year there will be, those are still open questions. So in this context of high prices, should we be concerned with support for agriculture? And the answer, I think, is unambiguously, for a lot of reasons, yes. Obviously, the strong prices put renewed emphasis on the kinds of investments we need in agriculture, both public and private, and certainly on an international level, the United States, for example, is making a substantial renewed commitment in that area with the Feed the Future and other programs, less so in its own domestic budgets for, say, agricultural research, but certainly importance there. Second thing is that high prices are not carte blanche for individual countries to pursue high levels of support and highly protectionist policies individually. And so we have a continued concern, as was expressed this morning, with opening markets and reducing support to agriculture that's trade and production distorting. And finally, let's face it, we're in an environment where fiscal costs, fiscal deficits, fiscal costs, taxation, and so on are dominant political issues in a number of countries. And agriculture is a small piece of that pie, but it's part of that discussion. Second question is, what's going to happen to U.S. and EU policies? We might have thought that in a period of high prices, all this discussion of support for agriculture would disappear because the subsidies would disappear. That's not happening. So what's going to happen with U.S. and EU policies? We've heard a little bit about that already this morning. Third, the WTO is the legal framework that we have for disciplining agricultural subsidies on a global basis. And so I'm going to work within the WTO framework. Now, as I'll mention on the next slide, WTO data is now becoming a series for countries, and all WTO members participate. So we have an assessment of the subsidies countries acknowledge in their WTO notifications and the way they classify them as those notifications. Using that as a basis for talking about subsidies has pros and cons. It's not as closely tied to economic concepts as what we might design as academic economists, but it does have the strength of this is the legal framework in which we're talking. So I'm going to talk about agricultural subsidies within the context of that legal framework and try and point out within there, again, some of the distinctions from pure economics. And then finally, what about the developing countries, the emerging economies and so on? What's happening to support policies in those countries? Now, there's two reasons. That used to be sort of a country-specific issue, but now you have a growing importance of the emerging economies in the total world economy, and you have this sort of stylized fact that in many countries, as incomes go up and agriculture becomes a smaller sector, support for agriculture actually rises. So will these countries be the large subsidizers of the future as their incomes grow? So that's the set of questions. Again, the plan of the presentation is to quickly review the WTO framework and look at the U.S. and the EU in that framework, then turn to the U.S. and EU current policies, then turn, if there's time, to the BRIC countries as including some of the major emerging economies and representative of the heterogeneity that exists about agriculture across the developing world, and then make a few concluding remarks. Now, one last introductory part. This talk is based on a number of research projects in which I've had the opportunity to work with some great colleagues as co-authors and as chapter contributors to this book that was mentioned. And so I just wanted to point out, mainly for when this paper's when these are posted, that there's some written documents you can go to dig into these things in greater depth. I also want to acknowledge at this point Lars Brink, who's here, sitting here, who's been a key collaborator. He and I have been partners now for 6 or 7 years and continue this partnership on working on these issues and looking at domestic support through the WTO framework. So here's a beautiful graph. I'm sure I think you all know the framework somewhat, but here's a reminder, and for those of you who don't know it, beautiful schematic that Lars came up with that quickly lays out the whole picture. So you start with all measures to support agriculture. You split off what the WTO calls the green box, which are legally agreed to be non-trade distorting or minimally trade and production distorting. So that's the legal language, and there are criteria policies have to fit to be measured and included in the green box. All right, but that doesn't mean they have no economic impacts. That's just been agreed in the WTO. That's the category they fall into. So, there's always constant churn and discussion about how much trade and production effect these policies have. If you split off in the other direction, things that don't fall into the green box, you have a series of other boxes things fall into. So the first one is the development box, which is only for developing countries, but allows them to include input subsidies and investment subsidies in agriculture that in developed countries would be considered subsidies subject to a nominal cap. Developing countries have an escape hatch on that and can use that and have subsidies in that category that are not constrained to be below a certain limited nominal value. Then you've got the blue box, more familiar in the developed world, which is for policies that are not on all of production and associated in some ways with some supply management dimensions. And then finally you've got everything else, and that's where the nominal cap comes in. So you have what's called this aggregate measurement of support that you calculate for each commodity and for non-product specific category. And you sum all those up. Now there's yet another escape clause. If your support for a particular commodity or in this non-product specific category is less than 5% for the developed countries, 10% for most developing countries, you also don't have to count it against some sort of nominal cap. And you add up all the support that's in this AMS category and exceeds the de minimis. You calculate a current total AMS, and there's where the single nominal binding that the WTO legal framework provides at this point is that each country can't exceed some fixed number in nominal terms based on historic support they provided in 1986 to 88. So that's the framework. Now, I think you can see very quickly from Lars' nice schematic that this is a pretty lax set of rules. It's lax in these various ways of wiggling around some limit, the nominal cap, and the nominal caps are pretty loose. So let's move quickly on to what's in the AMS. Well, it's payments, as we'd anticipate, of various kinds, mainly payments to farmers. And then this funny measure of market price support that the WTO uses, which is very structured. You take the administered price, you subtract a fixed historical price from the 1986-88 base period, and you multiply that by the eligible quantity of production of that product, and that becomes what you report to the WTO as market price support. That's not what we think of as market price support as economists. We think of some difference between the current domestic price, the border price, as, say, measuring protection if the domestic price is higher, and that applies to the full quantity of production in the country. So very important to keep this distinction. This very stylized, legalistic measure of market price support is reported to the WTO, distinct in your mind from the economic measure of market price support. Can be some correlation, but they can be quite non-correlated. And some countries have reported very substantial drops in market price support as measured by the WTO, even though the economic market price support, which would include tariffs and so on, hasn't changed. So you get some distinctions there. And again, as I say, there's pros and cons of measuring support either through the WTO notifications, through the OECD PSEs, and so on. Well, let's move on. This is the cat that got away, so to speak. What might Doha have done? And there's just quickly to make a point. These are the 8 countries that were in our group study. And to quickly make a point, look, the Doha Round would have substantially reduced this existing nominal cap on the AMS support. For the U.S., it would have gone from 19.1 to 7.6, just to give you an example. The de minimis allowance would have gone from 5% of value of production to 2.5% for the developed countries. In addition, you would have gotten a limit on the sum of the AMS support in the current total AMS, the de minimis AMS support, and the blue box support, what's called overall trade distorting support. That limit alone for the U.S. would have only, in total would have only been $14 billion, as opposed to the $19 billion limit we have now on only one piece of that set of expenditures. The blue box would have been limited, and there would have been product-specific limits, which would have been quite significant. For developing countries, it's not quite the same. The rules in the Doha Round were not tightened up as much for the developing countries. Brazil is a developing country that has a non-zero cap on its AMS support. India and China and the Philippines don't have that cap because they weren't providing any support back in the base period. So their cap is essentially zero. So they can't provide, they don't have that flexibility of using that AMS space to support one commodity or another. So Brazil would face some reductions in Doha, similar but less stringent than the developed countries, and for China, India, and Philippines, very little reduction. Now, quickly look at 2 pictures. We know these stories. In Europe, what's happened is they have moved away from the higher price supports. As they've done that, their economic market price support has come down. Their WTO measured market price support has come down. One-to-one correlation? No, but movement in the similar direction of these 2. They first moved into blue box policies, and so you see a large blue box, and then eventually moved those policies into green box. This is the OTDS support, so the green box is not there. So the EU, the main EU support, 30 or 40 billion euros a year, now categorized in the green box, is not showing up here. That's where they've moved to. Now, the bars include all the different categories of OTDS support, but the lines are just the limit on the CTAMS that exists under the Uruguay round. That's the higher line, and what would have been under the Doha round if it had ever been concluded. Now, interesting thing to note here is that by 2008, by design, the EU had become compliant with what would have been the long-term phased-in limits under the Doha round. So problems with domestic support were not what held up the Doha round as far as the EU was concerned. What about the United States? Very different picture, as we know. The United States uses a lot of payments. They are counter-cyclical, so in periods of low prices, the payments go up. And in addition, we see the critical role that the de minimis category, the non-product specific de minimis, which is 5% of the total value of agricultural production, we put a lot of payments to crops. We take the total value of agricultural production, including livestock production. That becomes our de minimis limit. A lot of room to put money in there. The U.S. has put a lot of money in there. It's been controversial. You see that without that exemption, we would have bumped over our WTO limit. So in the U.S. case, market price support not so important. That's basically dairy and sugar. The U.S. by 2008 is also compliant with the long-run Doha commitments, but more by circumstances of high prices than by design change in policy. Okay, now let's, with that background, let me move on to current U.S. 2008 was the beginning of the higher price period. So now we've had this higher price period. Here's just one slide about the EU. The EU is sticking with its high levels of green box decoupled payments, 30 to 40 billion euros a year, about 10% of the total value of agricultural production in Europe. This is the core of their program. It's WTO compliant, although it may have some economic impacts. They're talking about redistribution, where it's more evenly shared within countries and across countries. They're talking about adding additional environmental considerations that farmers would have to agree to. This is what was proposed by the European Commission, been under discussion since 2011. Where do we stand as of last week? The EU is now talking about a 10% reduction in the nominal expenditure on the cap. And associated with that, the farm groups are pushing back very hard on not wanting to have to comply with additional environmental compliance regulations as part of the cap reform. So that's where the debate is, and that's all I'm going to say about Europe. I usually defer to my European colleagues on Europe. Let's talk a little bit about the United States. Here, lots of things to talk about. We all, as I'm sure you all know, the last Congress at the very end extended the 2008 Farm Bill. So we're into somewhat unusual circumstances in the United States about renewing a Farm Bill. It's often been the case that a Farm Bill, like the 95 Farm Bill became 96, the 2001 became 2002, but it's not in any other time in recent history been the case that one Congress ends without passing a Farm Bill and the permanent legislation would come into effect. We had to extend the Farm Bill to keep dairy prices from doubling in the United States under law, and that was done at the very last minute, 1-year extension of the Farm Bill. That means the new Congress actually has to start all over again. The old bills are no longer in play. Committees have to pass out a new bill. Now, they may pass out the exact same bill. The Senate leader has reintroduced the Senate bill from July of 2012 as the new bill. The committee will then meet and see if it wants to revise it, but it's been reintroduced exactly the form of last year. But it is a new Congress, and this is a stronger failure of the farm lobby to secure a new 5-year farm bill than has occurred in those cases I mentioned, 95, 96, 2001, 2002. Now, what's in it? Let's just start with the basic. The basic story of what the U.S. is going to do, as was mentioned this morning, the U.S. plan in these pending farm bills will eliminate I should have mentioned, the U.S. is spending $5 billion on green box compliant, presumably green box compliant, direct payments to farmers. It will actually eliminate those. Europe has made that the core of its policy, WTO consistent. The U.S. is saying these are unpopular with taxpayers. We're going to not necessary for farmers with high incomes. We're going to eliminate those. Well, maybe it sounds good as a farm policy reformer, but what comes in place of that? Well, what comes in place of that is a strengthened safety net for farmers, downside risk protection for losses that wouldn't be covered by current crop and revenue insurance. Now, in crop insurance, which used to be a small program, has emerged to become, at this point, the largest U.S. program. The subsidies for crop insurance for the past 5 years have been larger than the $5 billion each year of direct payments. So this has slipped up as the new focus of U.S. farm policy, and the 2012 Farm Bill would extend that safety net and strengthen it even compared to what insurance is currently covering. The table is a couple points to make about the table. First of all, you can see that the farm safety net is the commodity programs and crop insurance, and you see that under the 2008 Farm Bill, the projected spending for the next 10 years is higher on crop insurance than on commodity payments. The next point is that in giving up these decoupled payments, $5 billion a year, $50 billion for 10 years, it's not that the farm sector is losing all that support. They claw back almost all of it and end up with only about 10% less support under these proposed 2012 farm bills in crop insurance and commodity programs than they had with the direct payments beforehand. So it's a clawing back and a bringing it into a more potentially production and trade distorting direction, and that's what's troubling from the point of view of concerns about distorting policies around the world. Now, I don't think we have time. I can see I'm running out of time, so I'm not going to talk about sort of the politics of why did the farm lobby fail in 2012, this powerful U.S. farm lobby. Why did it fail to secure a new farm bill? But maybe in the discussion period or in the break, we can talk about that set of issues. Now, if we dig a little deeper into the farm bill, I'm going to skip this slide, which puts it in words, and just go to this schematic, which sort of lays out. You think about farm policy evolving over time, so there are antecedents to policy. The issues in the debate in the U.S. this past year and a half have been, what are we going to do about shallow losses? These are, I mean, what a beautiful phrase. It's a Saturday Night Live TV says, shallow losses, permanent disaster relief. I mean, agriculture has come up with these great phrases, you know. So shallow losses are ones that the current insurance, which is highly, highly subsidized already, doesn't cover those losses. So these shallow losses, we have to protect agriculture from these shallow losses. That's been part of the debate. And then what do we do about multi-year losses, a potential period of lower prices that lasts several years, so you don't pick that up in just an insurance-type program that's within year. So that's the two columns, the three columns, antecedents and these two categories. So you start with the traditional commodity programs. The House of Representatives Agriculture Committee passed a new price-loss program that would essentially raise target prices, the traditional countercyclical target prices, tie them more to current production rather than base production, make it more trade distorting, and that was its policy proposal. Again, these debates have not been resolved because there is no new farm bill yet. Crop insurance, I've already mentioned its rising importance. Well, that led to this supplemental coverage option, which is basically you get some additional insurance and you have to pay for it. But you then get a highly subsidized additional insurance to cover some of these shallow losses. The STAX program is that kind of program for cotton. There's no PLC program for cotton because of the Brazilian cotton case. So it is not true, despite the lack of a Doha agreement, it is not true that the WTO doesn't have some important roles to play even under the current circumstances, under the current agreements. There is no PLC program proposed in the U.S. Congress for cotton because we have to reach an agreement to resolve the cotton case in this 2012 Farm Bill or continue making direct payments to Brazil to keep them from putting retaliation on, approved by the WTO because of our violation of, because we lost the cotton case. So long story, lots of details, but the STAX is the cotton version. One version has no minimum price, so that provides this shallow loss protection, but SCO only applies within the crop year. It's only an insurance program on year by year, but the House version of STAX includes a minimum price. Now, it's not clear the Brazilians would accept the House version of STAX as resolving the cotton case, but that's what's in the House version. Now, once you put a minimum price in, we'll see in a minute, it makes a big difference to how much expected payoff you get from this. Once you put that minimum price in, then you get multi-year protection. Again, not clear that Brazil would accept that as a resolution of the cotton case. And then finally, you had the ACRE program introduced in 2008. Prices were high. It's the first revenue guarantee program. A revenue guarantee starts from past revenue. If you start at a high point, you're insuring farmers against the first downturn. So that revenue program, ACRE program, was optional. Not many farmers signed up for it. You paid a penalty for signing up. That's now been built into programs, both the House and the Senate, that both within a year and over multiple years would provide some support because you'd be guaranteed a certain level of revenue. That moving average revenue would come down over time, and that's one of the arguments of the proponents of this as opposed to fixed target prices, but you would be protected from the market dropping sharply. Well, what does all this mean? And we may not get to the BRIC countries, but what does all this mean in terms of some of the potential costs and where the debate is taking place? So here's a way to look at that. There's a lot of uncertainty because you have enormous uncertainty about what the future market conditions will be. You have all this plethora of new programs. You don't know exactly which ones farmers will choose. There's all sorts of complicated rules for which ones they can be in and which ones they can't be in if they're in another one and so on. So we have the CBO estimates. I showed you those. I got 10 minutes, okay. I showed you those a few minutes ago. So the CBO is trying to say, in some sort of stochastic way, given some expected level of prices and then the variation we anticipate around that prices, what might these programs pay out? Because they pay out based on the variation. If you have a revenue guarantee, it doesn't pay out if you get a higher than expected revenue. It pays out if you get a lower than expected revenue or lower than past moving average of revenue. So here's two columns. The first column is taking the CBO prices, anticipated prices for the next 10 years as sort of the mean, doing this stochastic simulation. This one is by Bruce Babcock and Nick Paulson at Iowa State. Doing this stochastic simulation about them, what does the program pay? And the other is saying, suppose the CBO just has it wrong. and the prices are turn out lower then you've got to create a scenario of what you mean by lower, and they create a scenario of what they mean by lower. Then how do these programs look if the CBO just has it wrong? Demand collapses in the world, also exchange rates change, whatever. So the point is that if you look at the first two columns, the first two blocks in the left-hand column, what you see is, except for rice, these new revenue guarantee type programs look like they pay out more on average per acre than the PLC that the House passed, the traditional countercyclical price, fixed nominal price support program. But for rice, it's just the opposite. So you have what's been characterized, as a Midwest versus Southern agriculture, and you see it in these numbers. Rice does not do very well in terms of the benefits it will get if you go to these new revenue insurance programs versus the kind of countercyclical programs we had in the past. And so naturally there's a split between rice and the other commodities over which way you should go. Now, if you look at the lower prices compared to the higher prices, that's lower than CBO projects, you get larger payments, but the payments are a lot larger if you fix the nominal target prices than they are if you have this moving average of revenue guarantee. So again, this is an argument of the proponents, like my colleague Carl Zuloff at Ohio State. This is an argument of the proponents that it follows the market. It lags the market, but it follows the market. So if prices go down and stay down for a period of years, as in this low price scenario of Babcock and Paulson, then you don't get the support provided for as long. There's something to that, because if we'd had only that program for cotton back in the years that that Brazil took the cotton case over, if we had only that program and Congress had not intervened to provide more support when prices were low, there probably wouldn't have been a cotton case, because cotton support would have come down fast enough that Brazil wouldn't have argued for the price suppression in world markets. So these are non-trivial differences in policy design. Well, I'm running out of time, so what I'm going to do is jump forward, leave the U.S. and the EU, and talk just very briefly about these emerging economies, because this is such an important part of the global policy debate now that there's lots more I'd like to say about the U.S. and the impacts of the EU policies and the U.S. policy and so on, but we'll just leave it there. So Brazil, India, Russia, and China. This graph just shows you, these are very different countries from the developed countries. So we have to be reminded that, first of all, we know China has been growing enormously fast. That's what the first graph says, the upper left-hand corner. That's that fast growth is China's real GDP growth, with India coming along from a lower base and not as fast, and Brazil and Russia not growing as much. Now, the interesting thing is agriculture as a share of GDP decreases with growth. So you see in the second graph on the top row, to the right side, is the share of agriculture in GDP, and that's India at the top. So these are countries with a different kind of agricultural sector than, say, the U.S. has, and different set of policy issues and so on around that, and this is all part of the global debate. Now, the interesting thing is how low the percent of GDP, agriculture, is to GDP in Brazil. We think of Brazil as an agricultural powerhouse. Where Brazil shows up as an agricultural powerhouse is the percentage of its exports that are in agriculture. That's the lower graph on the left-hand side. And Russia shows up as standing out for the percentage of its imports that come from agriculture. So, the circumstances of agriculture affect the policies of these countries. We don't have time to go through this picture. This picture is from the WTO book that Bruno mentioned. We don't have time to go through this, but here's in a sense the bottom line. There is some little evidence of non-product specific kinds of support rising in the developing countries like India and Brazil. There's some evidence of that. The levels are still quite low. The market price support is not well reflected in the WTO numbers because of these eligibility, quantity, and administered price rules. And the green box investments, if you focus on just agriculture, not consumer subsidies, are relatively low, a problem of substantial, too low an investment in agricultural productivity is one interpretation of that. So we don't have time to go through that in depth, but again, there's various places where that's described, including the book and an IFPRI brief about that and so on, and a paper Lars and I have in the UK Journal of Agricultural Economics. coming out in February. Now, but I want to focus on two other quick points. And these will be the last 2 points. I won't make any concluding remarks. One is our lack of knowledge about domestic subsidies in the developing world. This is a table, Munasamy Gopinath, professor at Oregon State, was our analyst of India in the project on the WTO domestic support book. And he went back last year to update his analysis. And this is the best he could do on their input subsidies. Input subsidies are large in India. As you can see in these numbers, the input subsidies as a percent of value of production were 8.9% in 2004, jump up to, below de minimis, by the way, jump up to 17.9% in 2008, and then you see these NAs for 2009. India does not participate in the OECD. Russia, China, and Brazil do, by the way. India does not participate in the OECD exercise of producing PSE. So we don't have good knowledge about India. And, despite Gopi's training at Minnesota, professorship at Oregon State, Indian origins, good trade economist, trip to India last year to try and update these numbers, good network of colleagues in the country. This is the best he could do. And so we lag in our knowledge of really what the levels of subsidies are in these countries. So I want to just emphasize that for the importance of our countries putting some resources into this monitoring as these support policies in developed countries become potentially more and more important to our own agriculture. Last slide, and this is the last one, I won't make any concluding remarks. Russia, and this work is all the compilation of Lars Brink and published in a joint paper of ours. Russia has just acceded to the WTO. The rules for Russian domestic support, guess what? They're lax. They're lax just like the rules for every current member of the WTO. So we can't expect miracles out of Russia's entry into the WTO, but it does for the first time bring Russia's domestic support, its SPS policies, all of its agricultural policies under what disciplines the WTO does provide. So in this case, what Lars demonstrates in this table is Russia, like Brazil, will have a binding on its AMS, a positive binding. So it can maneuver within that to provide a lot of support to one commodity or another, because there's no commodity limits under the WTO rules. A curious thing about Russia is that it created that non-zero binding because of historical support that was in the non-product specific category. Very unusual that a country's base level of support comes from the non-product specific category. That creates a little bit of a problem because there's a lot of easy ways to move non-product support below the de minimis, because the de minimis limit's so high, or some of it into the green box. In other words, have that all of a sudden disappear because it goes below de minimis, and then you sit with a big box of support latitude that you can pour into trade distorting and production distorting commodity-specific policy. There are in the accession agreement some limits on that, but they're not very strong. I will leave that for discussion in the session and in the coffee breaks. Thank you very much.